5 of the biggest names in finance just locked their investors' money. $265 billion in market value gone. And if you have been online, you would have probably seen some people warning about the next private credit bomb. But when you dig into the actual data, most of the underlying loans haven't defaulted and the money is still coming in. So is this really a crisis, or is the panic actually worse than the problem? In this video, I will break down what private credit actually is, why these funds are freezing withdrawals, and whether this is really a crisis that's about to happen or not. Let's not waste any time and let's jump right in. Most people have never heard the words private credits until about 2 weeks ago. And honestly, that's by design. These funds were built for institutions, pension funds, endowments, and sovereign wealth, and not for retail investors like you or me. To understand how we got here, we need to go back to 2008. So after the financial crisis, regulators came down hard on banks. New rules like the Basel III forced banks to hold more capital against risky loans, which meant that banks had to stop lending to a huge segment of companies. This included mid-sized businesses, software startups, and companies with decent revenue but not enough to get a traditional bank loan. But then, they still needed money. So how? So private credit funds step in to fill that gap. The idea is simple. These funds raise capital from the same institutional players and lend it directly to companies at a high interest rate. Borrowers typically pay around 9 to 10% in interest, while investors receive around 8 to 9% interest. This is well above what bonds or savings accounts had to offer. And for a while, it worked incredibly well. From 2014 to 2025, the markets exploded from about $500 billion to over $2 trillion. Wall Street saw the returns and of course couldn't resist packaging this for high net worth and retail investors through semi-liquid funds, BDCs, and private credit ETFs. But here's what most people miss. Unlike stocks or bonds, these loans don't trade on any exchange. There's no market price, and the funds themselves decide what their assets are worth. And when everyone is grading their own homework, that's when the problems start to appear. Now, if you want to start investing, you need to keep your costs low. That's why I use interactive brokers. With interactive brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform, so you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video. So what happens when investors stop trusting the grades? They want out. And that's exactly what's happening right now. During the first quarter of 2026, investors in BlackRock's H-Land fund requested withdrawals equivalent to 9.3% of the fund's total shares. But because these loans can't be sold overnight like stocks, the fund is structured to only allow 5% withdrawals per quarter. That meant that nearly half the requests simply couldn't be fulfilled. Meanwhile, Blackstone's BCRED, the largest private credit fund in the world, saw redemption requests worth 7.9% of the fund, while Morgan Stanley's funds got hit with 10.9% in redemption requests, but could only pay out about 45.8% of what people asked for. Cliffwater saw a record 14% in requests, capped at 7%, while Blue Owl was overwhelmed with so many withdrawal requests that they just suspended redemptions entirely and are now liquidating the fund while returning just 30% of investors' money. Basically, there's a bank run on these private credit funds, and thankfully, it's not caused by some influencers this time. But what's causing all these mass withdrawals? Two reasons. The first is what some analysts are calling the SaaS apocalypse. Private credit funds lend heavily to software companies. In some portfolios, software makes up 20 to 25% of all loans, while Blue Owl's exposure is estimated to even reach as high as 70%. That seems safe when software valuations were sky high. But with AI now disrupting the entire sector, enterprise software EBITDA multiples have collapsed from around 30 times to 16 times, wiping out roughly $800 billion in enterprise tech value. And all of a sudden, the companies that private credit funds lend to are worth a lot less than when the loans were made. The second reason is something JP Morgan did. Basically, they look at the software loans sitting inside these funds and say, hey, these aren't worth what they used to worth. So they marked them down and restricted lending to the funds. This forced the funds to deleverage. Less borrowing power means less ability to make new loans, which means less income. And that spooked investors even more. On top of that, the default numbers aren't helping either. Fitch's private credit default rate hit 5.8% through January 2026, the highest since they started tracking. And for software loans specifically, Morgan Stanley projects defaults could reach as high as 8%. Meanwhile, more borrowers are paying interest with debts instead of cash, or something called PIK. That's now running at around 8% of total income and climbing. And it is a warning sign, because it meant that if companies can't pay cash interest today, they might become the defaults of tomorrow. So that's the current situation. And there are some data which might suggest that this is just the beginning. Looking ahead, there's a $12.7 billion worth of BDC debt maturing coming. That's a 73% increase over the prior year. And it's not just the US. S&P Global is warning that European private credit funds are starting to see the same redemption pressure. And in Canada, about 40% of $30 billion in private credit funds have already frozen withdrawals. The last time something like this happened was in June 2007. Bear Stearns, one of the biggest investment banks at that time, froze withdrawals on hedge funds. 15 months later, the entire financial system collapsed. So how bad this could get? Mark Goldberg estimates that 80% or more of semi-liquid private credit funds will be in net outflows by Q2 or Q3, with the negative cycle lasting up to 2 years. PIMCO has also been warning about sloppy underwriting and years of bad loans quietly stacking up. Case in point, First Brands Group was caught faking their books to borrow $2.3 billion from private credit lenders. After it blew up, Jamie Dimon famously said, "When you see one cockroach, there are probably more." Okay, so that's a lot of bad news. But before you panic, there are 5 key differences between now and 2008 that most people are missing. Number 1. Banks are not holding the toxic assets. In 2008, banks were holding the toxic mortgage assets directly on their books. When those assets lost value, the banks had to immediately admit the losses. This wiped out their capital and forced them to sell even more at a loss, leading to a death spiral. Essentially, the banks were both the source of the problem and the reason it happened. However, now, private credit sits mostly outside the banking system. This time is the funds that hold the loans and not the banks. Big banks like JP Morgan have manageable exposure to private credit. So even if those funds take losses, the damage would stay mostly contained, meaning it doesn't ripple through the entire banking system the way it did in 2008. Number 2. Moody's Mark Pinto said it best when he said that this is a liquidity crisis and not a credit crisis. A liquidity crisis means that investors want their money back faster than the fund structure allows. That's painful and messy, but it is still manageable. A credit crisis means that the loans themselves are failing and the money is gone. Yes, Fitch default rate hit 5.8% and that is elevated. But in 2008, mortgage defaults exceeded 25%. So we are now nowhere near that level. What we are mostly seeing now is investors getting scared and wanting out. So while the loans themselves are under stress, they are not collapsing across the board. Number 3, the biggest funds are actually holding up and not breaking down. Take Blackstone for example. Despite the 7.9% redemption wave, they didn't just honor 100% of withdrawal requests. They also injected $400 million of their own money into the fund. This isn't something that you would do if you think the ship is sinking. And BlackRock's H-Land, even after capping withdrawals, the fund is still returning 10.7% annualized. Meanwhile, Apollo is also announcing daily valuations to increase transparency. These are basically the largest players in the space, and so far, they are still holding it just fine. In 2008, it was the opposite, where the biggest players were the ones failing. Number 4, the scale is completely different. In 2008, the mortgage market was $10.5 trillion. Every household in America was exposed, whether through their own mortgage, the bank, or their pension fund. Private credit today is $2.1 trillion. That's just 1/5 the size. And the investor base is mostly institutional, such as pension funds, endowments, and accredited investors. So regular retail investors have zero direct exposure to this. Number 5, the experts closest to the data are not panicking. Howard Marks, the founder of Oaktree Capital and one of the most respected credit investors alive, has said this directly. There's not a systemic problem. State Street Global Advisors, which manages over $4 trillion, put it simply in their 2026 outlook. Volatility ahead, not systemic collapse. So sometimes, just because you see a few cockroaches doesn't mean the whole house is coming down. Now, with that being said, I don't want to be blindly reassuring either, because there are indeed scenarios where this could get worse. 1. If software defaults hits UBS worst case projection of 15%, this liquidity crisis could tip into a genuine credit crisis. 2. If PIK usage keeps climbing and those deferred payments eventually turn into hard defaults, the losses could become real and not just paper losses. 3. Instead of tightening oversight, the SEC is loosening it. Chair Atkins is pushing to expand retail access to private credit while pulling back on how closely these funds are monitored. So if those three things go badly at the same time, that could trigger a broader market sell-off through contagion and sentiment. In short, the private credit market is under stress. But the people screaming "private credit bomb" are missing the structural differences. Banks aren't holding the toxic assets, the scale is smaller, and for most retail investors like you or me, our direct exposure to debt is close to zero. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.